It's very interesting. As you said, the data came out today, and one of the other telling parts of the data that comes out, not only does the Mortgage Banker Association tell you what the mortgage rate is that's, people are taking out right now, but they also tell you about what type of mortgage loan demand they're seeing. There's the loan application indices. And at this point, we are seeing refinancings pick up. They actually picked up earlier this month to the highest in 2 years. Still very low historically because there's not that many people with higher rate mortgages. But it's barely moving the needle for mortgage purchase loan demand, which is very telling. It means the housing market's still pretty much stuck at these levels. Whether, it depends on who you talk to. Some people think that home buyers are just being patient. They think rates will fall. Given that the Fed's going to cut interest rates, they may be sorry that home prices go up, and it may not get easier for them. The other question is maybe it's really still an availability issue because home inventories are their 4-year highs, and listings have picked up, but still low again by historical standards, especially relative to the number of households out there. But I think it really comes down to still an affordability challenge for people who want to take out mortgages. There's still barely 50% of borrowers who can really afford to take out a mortgage at this level relative to the median-sized home, because home prices, again, have just continued to go up with limited inventory.
Yeah, well, it's fascinating to me to think about, your average consumer who's contemplating a home purchase, especially those first-time buyers, how educated they really are on sort of the link between Fed policy and mortgage rates. I mean, do you think the general public has become aware enough to know that maybe if I wait 6 months, I'll get a lower rate than if I go today?
I mean, maybe if you're really in the home for a mortgage, and maybe if you're paying attention to USA Today headlines, but 6.5, 644 is still quite expensive historically, and a lot of people who do know anything about mortgage rates is like, oh, well, my friend has a 4% mortgage rate. So I don't know if mortgage rates above 6.5% is going to trigger much, and especially if you're an existing home owner with a mortgage rate in the 3% range.
Yeah.
Then it's still pretty inhibiting to think about a new home.
So I'm looking at the INGO function, the Bloomberg Index browser. I see the Bloomberg Mortgage-Backed Security Index up 3.79% this year. Where do we go from here, do you think? I mean, what's the call out there when you talk to your clients?
Well, getting back to the Fed question, in a way, because mortgage durations, their sensitivity to interest rates is actually based more on the longer part of the curve. We've had a pretty good rally in 10-year rates, for instance, and that's really we've had a little spread tightening, but that's really what's driven a lot of the returns for the mortgage-backed security index. The problem is the Fed doesn't control the longer end of the mortgage market, and they don't control the longer end of the interest rate market. And longer end rates tend to price in what they see going forward.
Okay.
So they're already pricing in a lot of the Fed cuts. The forward rate curve, which tells you kind of what market expectations are, only have longer rates falling by another 10 to 50 by the end of the year. So, good for mortgage returns. And one of the things that I wrote about today, actually, is the fact that to the extent that the yield curve is uninverting and it's getting cheaper for banks to hold their funding and buy mortgage-backed securities, or more attractive, we're seeing banks begin to come back into the mortgage-backed securities market, and they're a key, less economic buyer. So when they do that, mortgage spreads have more room to tighten, and that could add to mortgage returns between here and year end if that trend continues.
Yeah, I wanted to ask you about that. I noticed in one of your recent notes you pointed that out, that banks' MBS holdings have been rising. So that's not a sign of less demand from investors. That's more the banks are actively holding more of these securities?
Yeah, banks like mortgages for a couple of reasons, and they haven't liked them very much in the past 2 years.
Yeah.
They like mortgages because they have a good margin versus their deposits, for instance, that they're paying out on. Not so true in an inverted yield curve. And they like them especially when they think making loans might be a little bit riskier. They kind of weigh that variability between outright loans, whether it's commercial or residential loans, and mortgage-backed securities. And it's also possible that with banks worried about a bit of a slowdown in the economy, that they may actually think mortgage-backed securities, which are guaranteed principal and interest from Fannie and Freddie or Ginnie, that those are a safer bet right now than loans.